Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you're new here and enjoy today's video, be sure to hit subscribe and also hit like. It does really genuinely help out the channel a lot. So I'd really appreciate it if you could hit like on this video as well. Today what we're going to be talking about is stock market volatility. So all of this crazy up and down movement that happens in the stock market pretty much every day, and especially at the moment it's happening a lot. What do we do about it? Is it something we need to worry about? Is it going to hurt our returns? Is it going to offer opportunity? What do we sort of do about all this volatility, and what's the best way to think about it? So that's what we're going to talk about. Let's get into it. So the number one piece of advice that I can give anyone investing in the stock market when it comes to volatility is to breathe. Slow down, breathe, stop doing anything, stop getting worried about this up and down movement that's happening all the time. If you've got a long-term time horizon, it doesn't matter what the market price is tomorrow. That's the, long story short, that's what happens when markets are volatile. Things go up and down all the time. It really doesn't matter. Unless you're planning on retiring and selling everything and moving to the Bahamas next week, it doesn't particularly matter what your portfolio is doing next week or next month or even in the next couple of years, to be honest. So one of the key learnings from Ben Graham's The Intelligent Investor, which is, the book that Warren Buffett recommends to all people that want to learn investing, want to learn value investing, and how to think about investments and investing in the public market. There's number one sort of recommended book. There's two kind of key learnings that come out of that really apply to stock market volatility and what to do about that. So the first one, and I believe this is chapter 8 of The Intelligent Investor, is Mr. Market. So Mr. Market is this character that Ben Graham introduced, and essentially he's your business partner and he represents the stock market in this analogy. So Mr. Market will come to you every single day with a range of products, a range of companies in this case, that he will be willing to sell you, and he'll be willing to also buy back from you at whatever quantity you want, and basically every day you get these offers. The only caveat to this sort of beautiful arrangement where you can buy and sell anything from the same guy is that Mr. Market names the price. So most of the time Mr. Market prices things quite rationally. He prices based on the long-term sort of fundamentals of that company, but occasionally he gets a bit bipolar and he gets way too optimistic, wants to sell things to you for a really high price, but at that time he'll also buy things from you for a really high price. And sometimes he will get very sad and kind of pessimistic, and he will sell things to you at a very cheap, low price, and he'll only buy things from you at a cheap, low price as well. So Mr. Market is our business partner, and as much as we love him, we're going to have to take advantage of Mr. Market. Mr. Market is there to serve us. He is not there to instruct us. And that's one of the biggest learnings that you can take into the stock market as a practical takeaway, is that the stock market is there to offer you opportunity. It's not there to tell you what to do. It's not there to tell you when to sell if something's going down or when to buy if something continues to go up. We want to do the opposite. I think it was Warren Buffett that said the stock market is the only shopping center where when everything goes on sale, people run out the door. And when that shopping center puts prices back up, everyone comes rushing in to buy a whole bunch of product from that shopping center. So it sounds ridiculous when you think about it like that, and that's the best way to think about it, to be perfectly honest. When we want to buy businesses, which is what we're essentially doing in the stock market, we want to pick them up at cheap prices, and when people have been way too optimistic, we want to sell those businesses at massive profits ideally. So that's what we want to be thinking about in terms of, all this volatility. Essentially, it doesn't matter. If we get great bargains, buy up a hell of a lot of it. If we get, massive overpricing and you've got somewhere else that you can potentially put that money to work, sell out and buy the cheaper thing. Mr. Market is there to serve us. And we're small, little, nimble investors, so we've got a lot of advantages over the big guys. We can get in and out of these stocks quite quickly if we need to. Not necessarily saying that you should do that. I think for the most part, you should buy great businesses when they come up at good prices and pretty much hold them forever. But if you do have a situation where you've got a really, really attractive proposition, a great business at a cheap price, relative to its value, and you can also sell a current investment at way above its value, that's a switch you should make. So that's the first point around stock market volatility. Let's get into point number 2. My second piece of advice around investing in volatile markets and doing well through these sort of times is also a concept from The Intelligent Investor, and this is margin of safety. So this comes from chapter 20, I believe, of The Intelligent Investor, and it's probably the most important lesson in there. Margin of safety. The 3 most important words in investing are margin of safety. So what this means is essentially we want to buy a business for less than it's worth. In practice, that's what margin of safety is all about. So we want to make an assessment of the value of a business. We want to make sure that assessment is relatively conservative. Then we want to buy that business for much less than what we think that business is worth, and that gives us a margin of safety. Even if we're wrong in our analysis, we can still generate good returns because we've bought it so far below the value. And it really stops us from speculating and making short-term decisions around the fact that prices are just moving all over the place. If something's worth $100 and we buy it at, let's say, 50 to 60, somewhere around there, we've got a big margin of safety. That's fantastic. If it goes up to 70 and then starts jumping all around the place, going 75, 65, 80, doing all this kind of stuff, it's still undervalued. It still offers us a margin of safety, and it really doesn't matter what it does in between. We're focused on what the underlying business is doing, and we know that this thing is worth $100, assuming that the story doesn't change with the business and something catastrophic doesn't happen with the business. So always buy with a margin of safety. It's going to keep you investing, and it's going to stop you speculating, and it's also going to help you from avoiding massively overvalued situations. So when you invest in something that's hugely overvalued, you can have big losses. And this is something that the greatest investors in the world know sort of inside out, is just the simple mathematics around what happens when you have a big loser. So if I just give you a quick example of that, if we buy something at, let's say we think it's worth $100, someone thinks let's say it's worth $100, but we are speculators. We never made an actual assessment of the value. We just saw this thing was going up and we thought it was going to keep running up further, which unfortunately this is what most people do. And let's say we buy it for $200. Eventually reality is going to strike. In the short term, the stock market is a voting machine. It's just going to do what everyone else's opinion is. If people think it's going to go up, it's going to keep going up. If people think it's going to go down, it's just going to keep going down, regardless of the value. That in the stock market is what happens short term. But over the long term, the stock market is a weighing machine, and we will end up at this $100 value eventually. That is just bound to happen. Intrinsic value is gravity. If intrinsic value is higher than the price will rise eventually. It may take months, it may take years, but it will happen. And vice versa, if the price is way too high relative to value, eventually that will correct as well. So eventually we're going to end up at $100, and we're going to end up losing 50%. And what happens in that situation is, to get back to our initial investment level, our initial level of principal, to get back to $200, we actually have to make an investment. Rather than invest in something that goes up 50%, if we invest in something that goes up 50%, our new $100 is going to go to $150, and we're still going to be left, $50 short of our initial $200. So what happens when we have a big loss like this is we have to actually make a 100% return just to get back to where we were. I don't know about you guys, but 100% return investments don't come around that regularly, and they don't happen very quickly, especially. So avoiding losses and avoiding losers is massive in the stock market. And I'll give a quick shout out to Lewis Paz. I really hope I'm pronouncing your name correctly. If I'm not, let me know. He's a subscriber to this channel, and also we've been talking a little bit on Instagram, and he sent through a article that I'll link in the description below, which is all about limiting losers. And it actually talks about an analogy in tennis where basically professional tennis and amateur tennis are very different games. In professional tennis, that's a winner's game. So points are won by hitting fantastic shots and, hitting something just out of reach of your opponent. In amateur tennis, you win by not making a mistake. So you just have to keep returning the ball to the other person very averagely until that person hits it into the net or hits it out of bounds or anything like that. So investing, unfortunately, is probably in that loser's game amateur tennis category. Really, our true powerful tool as a value investor and someone that knows approximately what a company is worth when we assess it, our real power is avoiding losers. We don't have these big 50% drops, and over time that does wonders for compounding your wealth. So that's my thoughts on volatility. Essentially, I want you to take a step back, breathe, know the value of a business, and buy them if they're really cheap. Sell them if they're really expensive and you've got other opportunities to go into. So that's my 2 cents. Let me know if you guys agree with me, and if you've got any comments, definitely drop them down below. But until next time, I will see you in the next video. Cheers.